Posso prenderlo? Grazie.
Rimango qui così mi...
Perfetto.
Adesso magari faccio sì, questo le slide se sei seduto lo puoi girare. Okay, I think we can start. Good. So I introduce you, well, you know myself, and I introduce you to Francesco Colelli, who most people in Venice already knows because he was a visiting scholar at ICCG last year. So today we will present on carbon risk. So after COP21, so basically the carbon operator risk and the carbon asset risk. So we will really share the presentation with Francesco covering the carbon operator risk and myself covering the carbon asset risk. So please, Francesco.
So hello everyone. So, perhaps does the like this way. Okay, how did you do it? Okay, perfect. So the first concept that we introduce is the one of climate change related risk in relation to economic activities and companies. And this is comprised of two different risks. And we have physical climate risk, which is related to changes in the climate system, for instance, long-term temperature changes, but also extreme events or natural resources degradation and changes in availability of natural resources. And then on carbon risk, which is our focus today, which is instead the set of risks which are associated with the transition to a low-carbon economy. And main drivers in this case are government regulations and the energy technology innovation or market changes, but also social norms. And for instance, Isabella will talk later about the main points of evolving social norms, which is divestment campaigns, and also legal challenges. So if we focus on carbon risk, we can somehow then again differentiate between operator carbon risk, which is the risk which is faced by energy operators, and this in turn is divided somehow in three levels. There is the physical asset level, which is the risk for specific assets to face write-downs, devaluations, or impairments, and this has been called by the literature a stranded asset risk. In turn, of course, when impairment occurs, there is an impact on the valuation of the company, and so this is the second level. And again, there might be an impact on the creditworthiness of the operator, and it is called credit risk. Always at the operator level, so at the single firm or company. Whereas the carbon asset risk, which will be explained further by Isabella, it's instead a risk which is faced by intermediaries or financial institutions that have a stake or a financial or a relationship with these operators and companies. So if we focus on the operator carbon risk, and in the next slide we look at the examples of the oil industry extraction, or extraction industry, we can first of all, just 1 second. Sorry. We see that basically this operator carbon risk and physical asset risk depends on many factors. For instance, the profile of the asset, for example, fuel mix or the location, and also on the internal rate of returns and the earning margins which are required by the financial institutions that invest in these companies, as well as on, let's say, the competition which is faced from this asset to other low carbon technologies, and ultimately also on the operator's risk, on the operator's strategy, for instance, the divestment strategy or the operational risk management. So there are many, of course, factors that affect then physical risk, and we wanted to focus on the oil industry because it has been clear and shown clearly in the last years, first from the IPCC and more recently by Polikin's article at the beginning of 2015, that most of the resources which are available now and which do make for which could be economic sense for extraction actually do not meet carbon budget restraints. So there are 2.8 thousand gigatons of CO2 embedded in the whole set of reserves for oil, coal, and gas. And these papers by Ekin show that 35% of oil, 82% of coal, and 50% of gas resources cannot be burnt due to carbon considerations. And then we wanted to focus on the oil because, of course, as it's more capital intensive than the other sectors, actually the share of the capex at risk, of the capital expenditure at risk overall, are 75% of the all fossil fuels capex. So it's more important somehow for the stranded asset considerations. And this paper was really interesting also because it somehow gave some geographical distribution of the reserves, which are unbornable. And for instance, the Middle East holds the highest absolute share, 260 billion barrels, but in terms of relative shares, it's Canadian bitumen and oil sands, which are the one that of course are more carbon intense, and then which are not needed in a carbon budget scenario or by carbon budget considerations. And roughly 75% of Canadian oil cannot be burned. If we want then to focus on unlisted companies, we see that they embed roughly 1/5, so 760 gigatons of CO2 of this carbon budget. So basically the problem that there is, that has been shown by some research centers, is that the capital investments of these companies continue despite the fact that the reserves they're investing in are not consistent with a 2 degrees scenario, 2 degrees world. And of course, there has been, let's say, some disagreement on the issue. The first seminal report paper that has been published by the Carbon Tracker Initiative in 2013, the data was before, basically said that between 65 and 80% of these reserves owned by listed companies cannot be burned. But then some responses from the industry, from some other energy consultancies, argue that basically as the valuation of the listed companies is based on some reserves which are likely to be monetized, that will be fully extracted by 10 to 15 years, the time span is too short to be actually touched by climate carbon risk considerations. The point made instead by other research center and Carbon Tracker in particular is that, of course, if you then reinvest the revenues in other reserves extraction, and as we have seen in the previous slide, it is actually happening, then of course you're translating and transmitting the risk to the next 15 years in terms of investments, and then to the next 25 or 30 years in terms of production, because of course an oil field then, the production of an oil field lasts on average 10 years, and then the risk is translated up to 2030 or 2040. So this is somehow the counter-argument. And again, another point is that for some companies which maybe are not the super major but still very important players in the industry, part of the evaluation is not only based on reserves that will be monetized in the next years, but also on unproven reserves or undeveloped reserves that then need longer time to be economically feasible. A second point is that
Can you hear us from Venice?
Is Venice okay?
Are you there? Still there, Venice? Non so proprio neanche io. Qualcuno sa il numero almeno della
Reception è 34.
Chiama il 34.
Chiama il 34 che
sì, no, quello sì, proviamo a richiamarli.
Now, let's try now.
Siamo di tutte scene così.
Noi no.
Sì, abbiamo un veramente con Venezia, le abbiamo perse.
No, è quello è cosa. Venezia.
Venezia.
And Isabella?
Yeah.
Ah, ok.
Can I? Hello, sure.
Yes.
No, we don't. But we can see you.
Yeah, that's
Okay.
fine.
Okay, we go.
So this debate has been involving also the international, the IEA, and for instance, in this latest World Energy Outlook, they state that an overwhelming share of private reserves are actually consistent both with their new policy scenario and with the 450 scenario. So they actually state that there is no risk for the private energy operators in the sector. Always some points made instead by the Carbon Tracker Initiative are that in this regard are that the IEA uses a very large set of reserves in their calculation, and this of course is more unbalanced towards public companies, which own most of them in the 2030-2040 period. And another point is also that the statement is correct, that public companies own most of the unburnable reserves. Is correct only if assuming that in particular OPEC continue, let's say, a price stabilization strategy in case of lower demand in the future. And we have already seen in the last year and a half that this hasn't been the case, and they can actually protect market share. And then, of course, if demand falls in the next 10 to 20 years, they can either protect their market share or even increase them. And in this case, of course, the reserves that will be left to for exploitation to private companies will be lower. So what Carbon Tracker does, we'll see it in the next slide, but first you should introduce also more in general where does the carbon risk lies in the oil sector industry. So our first set of factors is it's not climate related, and it's due to economic reasons. There has been from 2000 to 2014 rapid cost escalations and capital intensity of the production of oil. In particular, capex upstream cost doubled in these 14 years, and at the same time, this came at an era of low oil prices. And so, due to these two factors, McKinsey recently, like I think 2-3 weeks ago, estimated that the potential cuts in investments of the industry in the next 5 years could go up to 1 trillion. So there is 1 trillion assets that could be cut, investments that could be cut in the next 5 years in the industry. Together with these economic restraints, there are of course COP21 related, climate related drivers that we saw before. And of course the most important issue to look at is the development of future oil demand. And there is a gap of roughly 30 to 45 million barrels per day. And if it's basically 1/3 of current oil demand, oil consumption. Oil consumption in 2014, I think, was 93, 94 million barrels per day. So in the forecast, in the scenarios, there is a 30, 45... should I wait? Yes.
Non li vedevamo, ma erano collegati.
Erano collegati, ma tu non li vedevamo.
Sì, stabilisco un attimo intanto.
Stabilisco
il collegamento così.
Ecco.
Si devono intervenire.
Sì, grazie.
Grazie.
Va bene, grazie.
So,
Yes, thanks.
perfect. So there is a gap of 30 to 45 million barrels per day between the projection of the oil majors and climate consistent 2 degrees scenarios. For instance, this is a study published by Cambridge Econometrics a few months ago, and it looks specifically at the transport sector. And it shows how, assuming like strong policies, strong technology forcing policies in the sector, for instance, this scenario assumes that in 2050, between 60 and 80% of the light vehicles would be electric based. So there are strong assumptions. Oil demand could be lowered, could be halved actually up until 2050, and this would mean from 24% reduction, oil price reduction in 2040 to 33% reductions in 2050. So just this is to give a hint of the different drivers that are at stage, and of course transport demand is one of the most important. So this graph is taken from the Carbon Tracker Initiative. So basically what they did was, stemming from, beginning from the debate we saw before, they decided to construct a carbon oil supply curve, which was not derived from the top-down approach of the IEA, but in a sort of top-down approach. What does it mean? They basically took the oil projects which were considered by the private and public companies to be likely to be developed in the next 10 years. So they did not consider the whole set of resources, of the reserves, but only the ones that are likely to be produced by these companies, and constructed the supply curve, and of course made it interact with different oil demand scenarios. In this way, basically, the different each point in the curve is one specific project, and the level of break-even price is the price that project needs to be economic, so to have a net present value of 0. There are then two curves because they differentiate between the internal rate of return of each project. So if you increase the internal rate of return, you need a higher price for the same asset to be economic. But in any case, regardless of the differences, what they find is that, let's say, a threshold price for an asset to be economic in a 2 degrees world should be at least $95 per barrel. So all the projects that have a break-even price lower than 95 are considered in this study somehow climate consistent, and all the others are instead considered risky assets. And what they do is then show the differences between private and public exposure to these assets. And the figures show that there is actually, that let's say this IEA statement, or in general the statement of the major oil companies, is not really consistent because the exposure is more or less the same. So 8%, 11%, and 12% are the percentages of unneeded projects out of the total projects online now and in the future up to 2025. 2025 in terms of capital expenditure, whereas 2035 in terms of production, because as we said before, each project has a 10 years lifetime. So if we invest up until 2025, then we have production up to 2035. So if we include both projects online now and new projects, the share is 8% for national oil companies and 11% for the major oil companies. But if we only focus on the production of new assets, the one coming online from 2015 to 2025 in terms of capex, in terms of production, is 38% and 34%. So again, there is no difference basically between national oil companies and private oil companies. In this case, major oil companies. And this share is even higher if we don't consider production but capital expenditures, meaning that these projects which are very expensive are actually the ones that are more capital intensive. And we can go forward and look at the distribution, at the category distribution of this capital intensity, and we see that let's say the highest cost oil is Arctic and oil sands, because 62% and 90% of overall projects are not needed in this 2 degrees world. And most of these projects are held by private companies. Hence, we don't really, what the carbon tracker concludes is that we don't have to look at the volume of the reserves which are unburnable, as previous studies did, but on the value of these reserves, of course. And for instance, other projects, as shale tight, show that basically it's not only a cost consideration, but also it's a consideration that depends on the characteristic of the oil fields. So if the oil field is more flexible and production can be put on hold more flexibly, then of course the same project will have a lower risk. And this characteristic is, for instance, shale oil's major characteristics. So shale tight oil is relatively less risky in these terms. Here again, we can show that the companies which are more exposed are the ones that focus, of course, on one single set of oil, on one category. And the figure shows, always by carbon tracker, that from 50% to 100% of the oil which is embedded or which is property of specialized private companies, it's not needed in this 2 degrees scenario. So it's basically higher than the threshold price of $95. Instead, so these are relatively smaller companies, but then if we look at oil majors, here the time scale is relatively different because it's another report always from carbon tracker, but we can see that unneeded production, in this case again production that needs more than $95 break-even price up to 2050, it's from 15% of ENIs to 35% of ConocoPhillips. So annuity production is actually an important share of the portfolio, future developments portfolios. And again, the percentage increases if we look at CapEx, because these projects are extremely capital intensive. And here we look again at 2025. So in a medium to low term, let's say, outlook. The important point is then what to do after this consideration. So there are different strategies that private companies can engage on. And first of all, they should put CapEx into context. So if they are investing in a project with a break-even price which is higher than $80, $85, $90, they should understand where, let's say, the timing of that CapEx compared to the overall project, and also the share of the CapEx of that single project on the overall portfolio, as well as also be careful of differentiation in regional and also on oil category terms. And then, of course, the projects that need to be assessed more carefully are the one on the right side of the supply cost curve. And also, as we saw in the case of tight oil, the projects that are have higher lead time and long payout times, which are less flexible than the opposite, of course. A third point is cost deflation. Many reports in the industry, and this figure is taken from Citigroup, argue that there is potential for cost savings, and that's absolutely true. There is potential that goes from 10% to 40% in some cases of oil wells for their cost to be reduced. But the point is that the projects at the right hand of the cost curve, again, are the ones that have fewer opportunities in this sense. So another important point has been made again by the Carbon Tracker Initiative. What they did was taking all these projects that are consistent with the 2-degree scenario, so that have a break-even price lower than the threshold, and construct a portfolio only with these projects, and then comparing it to a business as usual scenario, business as usual portfolio with all the projects that are on, let's say, likely to be developed if no action is taken. And what they show is that both, like the portfolio which is 2 degrees consistent, it's actually performing better compared to the other, up to a price, an oil price of $120. So if in any scenario with a price lower than $120, a 2 degrees consistent portfolio is more performing, and they make, for example, this portfolio would be $55 billion more, but would be valued more by $50 billion than the business as usual portfolio. So let's say an argument that could be made that a 2 degrees portfolio could be not as, let's say, could not have a high value in, say, $100 scenario. It's actually not true. And one of the last points that Carbon Tracker makes is that due to these considerations, it would make sense for investors to actually price more in terms of credit and internal rate of return required a company which keeps a business as usual approach. So of course they face more risk, they face more volatility to oil price fluctuation, and this should be then, so we should actually see a difference in investment strategies, and this relates also to Isabella's part that will be presented in a minute. A second set instead of carbon risk is the one that is faced by electricity generation, and in particular on utilities, which have, let's say, in their portfolio big carbon-intensive generation assets. And the drivers here are of course, multiple, and in the case of Europe, we have seen in the last 5 years, or in the case after the financial crisis, that there has been stagnant or decreasing electricity demand, which has depressed wholesale prices, and on top of that, of course, renewable generation surging, and this has affected large utilities in 2 ways. First of all, by decreasing again wholesale prices, and also by shifting, let's say, merit order considerations. So basically decreasing the time, the operating hours of the plants. So lower revenues and lower time to be operational on the market for large scale energy projects. And a third driver has been and will be perhaps the one which will likely increase most in the next years is consumer demand response management and decentralized energy systems. So just to give a hint, of course, there is no strict causal relationship between these, let's say, long-run trends and the figures in the sector that we present here. So 5 largest power generation that lost 100 billion euros from 2008 to 2013. There are many considerations that enter, but of course there is a risk for these operators due to climate considerations. And we can see it in particular in the case of coal-based generation. And coal-based plant can be subcritical or supercritical. And countries that have so highly emitting subcritical plants are mainly Germany, Poland, and the United Kingdom. And so these are the assets that might face the highest risk of stranding. But at the same time, this is not somehow a justification for pursuing investment in supercritical, more efficient coal plants, at least in terms of carbon risk, because always Carbon Tracker Initiative and other reports showed that, let's say, the net present value of these supercritical coal plants is affected by climate policies, and it can, in a considerable way, like up to, let's say, 1 billion euros in their overall lifetime of the revenues that can be of a single company. And the drivers in this case are, of course, the fact that there is this depression of the wholesale markets, which is putting like a risk on high investing, high capital intense projects, but also emissions directive as the industrial emission directive or the large emitting plant directive by the European Commission in terms of, again, non-CO2 emissions. And then other factors are public oppositions and rising CO2 prices. And I put this at the end because, of course, ATS market is not as efficient in this regard. IEA's figures show that we would need at least $110 per ton of CO2 to make a switch between a coal-based power plant and a gas-based power plant, while instead roughly 60 euros per ton of CO2 are needed, not to switch investments, but to switch merit order considerations. So while 2 plants are already producing, $60 per ton would be needed to switch from a coal-based to a gas-based. Whereas, I guess, projections of ATS prices up to 2020 are of roughly $30 if the market stability research is correctly implemented. So, of course, there are not, the risk is relatively lower, but there has been an impact on levelized cost of electricity for these plants due to new regulation passed last year. And in this case, the strategies of the operators can be either short-term, and again, this can be cost savings or geographical diversification or hedging in the forward markets. And another, let's say, short-term strategy is to lobby governments for, let's say, passing laws that actually protect, in terms out of reasons of supply security, those plants that would be providing backup capacity, as of course coal or gas-based plants. So in Europe there has been an increase in the capacity remuneration mechanisms that do have this aim indeed. Instead, if we look at the long-term strategy, there can be, let's say, much more effective ways to deal with this energy transition, and that would be shifting to, let's say, retail services for these energy utilities, as for smart metering installation, or by the provision of grid-tied renewable energy, or by grid-scale storage. And an example has been, well, somehow the very forerunner level played by Enel, which already in 2008 split in Enel Green Power, which was then, and last year by E.ON. Basically these companies decided to split in a fossil fuel-based, somehow short-term focused company to instead, with another growth-oriented, long-term oriented, renewable energy-based company. I now leave. Yes, a last point is instead concerning the oil industry that we saw before, Well, investors, and this basically introduces Isabella's part, can engage in different ways, can actually put forward different strategies. First of all, it's important to understand the exposure of the companies, and hence the pivotal role played by the Carbon Tracker Initiative in showing how this assessment should be done. And then different strategies can go from engagement to disclosure and transparency requirements, which are all part of the carbon asset risk. And then I leave the word to Isabella.
Thank you, Francesco. So I will start with the carbon asset risk, which is actually the other face of the medal from the operator carbon risk. So what is a carbon asset risk? Carbon asset risk is the potential of an investor to experience financial loss due to unmanaged operator carbon risk. So all investors, asset managers and insurance are increasingly warning fossil fuel companies to assess and address the carbon asset risk, which is basically a function of the type of financial relationship with the operator and its duration or tenor. So understanding of where different types of financing sit in the capital stacks is key. So all specific aspects of financing affect both the risk and return profiles of a financial investment and determine whether operator carbon risk translate into a carbon asset risk. So carbon asset risk exposure, so basically the risk exposure of an investment is not only informed by financial assets and the tenor of the investment, but also by other carbon risk factors, such as Francesco partially introduced before, as the policy and regulatory factors, as well as energy innovation factors, economic factors such as the risk of today's decrease in energy prices, and last but not least, the most important for our financing industry is the reputational factors. So the fact that non-divestors may face reputational risk if they finally they get the downside risks wrong, or even like keeping investments into the fossil fuel companies, they make losses from fossil fuel investments. So I would like to differentiate, to show you the difference between long-term versus short-term carbon asset risk exposure. So it's before the stranded assets were perceived as a long-term risk for investors. So it was mainly entailing investors such as institutional investors, such as insurance companies or sovereign wealth funds. Today, stranded risk is really perceived as a short-term risk because also of the collapse of energy prices that have really, created revenues problems in fossil fuel industries, and they led, as Francesco very well said, to cut capex and operating assets, make operating assets unprofitable. So this really made the problem of stranded assets really concrete and urgent issue to address, and by investors and lenders, and also including those short-term investors such as private equity, even venture capital or pension funds. So it really interests all of the investment categories. This is what I would like to say. So how to manage the carbon asset risk? Basically, the first step by investors should be to assess exposure. So to assess exposure and to see where this stranded asset sits in their portfolios. Then they should evaluate the risk by, for instance, portfolio stress tests, which is also used by operators as stress test, but in this case we are speaking about investors, and stress test exists for investors too. And last but not least, they should manage this risk. So manage this risk is it can be foreseen, it can be managed in different ways. First, I will which are disclosure, engagement, diversification or reallocation, and divestment. First, I would like to explain to you what engagement is. So engagement, you can describe engagement through soft and hard engagement. So soft engagement is basically the fact that investors really engage with the company and assess and monitor through time the risk management approach adopted by the company. Whereas hard engagement is really something related to ownership. So it means that investors are shareholders in these companies, and so they can really influence them by sitting at the CDR, okay, in the meeting of the board, and really influence them by voting. So it's a hard engagement. What is reallocation? Reallocation or divestment is when the returns impacted due to climate change are hedged, and investors decide to, let's say, diversify their risk through reallocating their investments both cross-industry or cross-regional. So, and for instance, they could decide to reallocate some investments from fossil fuel companies to companies that invest into renewable energy or energy efficiency. And then disclosure. So disclosure is a prerequisite of the effectiveness of the assessment and evaluation and management of a climate risk. It's really something that comes before all the other strategies. So just to give you some example of international initiatives that have been undertaken, one is the Portfolio Decarbonization Coalition, which is a multi-stakeholder initiative that basically will drive greenhouse gas emissions reductions by mobilizing a critical mass of institutional investors. So pension funds, insurance companies, sovereign wealth funds committed to gradually decarbonizing the portfolios. And the Portfolio Decarbonization Coalition was actually the father of the Montreal Carbon Pledge, because in 2014, September 2014, many of the investors that are committed in the Portfolio Decarbonization Coalition decided to commit themselves into this Montreal Carbon Pledge, which is basically a commitment to measure and disclose the carbon footprint of their investment portfolios on an annual basis. And this entails, this carbon pledge entails commitments by 120 investors, and with more than 10 trillion billion US dollar in assets. So it's really a lot. And finally, I'd like to raise some, let's say, example as a best practice example in disclosure is made by the French energy transition law of last year, which actually asked for a mandatory climate disclosure. So it's a mandatory requirement to institutional investors to disclose their portfolio and in which, you know, their carbon footprint of their portfolios. And whereas in Europe now there is a non-financial disclosure directive that now has been in these days it's been amended, and possibly soon will be a new of non-financial disclosure directive in this sense, but still this is voluntary based. So this is the difference with the French one. And another strategy by investors for managing a carbon asset risk is the divestment. So divestment movement started in 2013 with the Carbon Tracker Initiative, launching Carbon Asset Risk Initiative, which is made by 75 investors representing $3 trillion US in assets, which called for 45 of the most, the largest fossil fuel companies to address both the physical and the financial risk of climate change. And as of September of last year, institutions and individuals representing 2.6 trillion in assets, US dollar in assets, have committed themselves to divesting from fossil fuel companies, especially from coal, those involved and those having exposure in coal and tar sands. So the ones that, as Francesca said, are the most, let's say, the most at risk of stranding. And so there are four kinds of divestment strategies. One is 100% divestment, so from all fossil fuel companies. The other is partial divestment, also called tilting, which can be pursued according to index classification or revenue criteria or even break-even prices. And then I will give you some examples of that. Then there's a worst-in-class approach, which is based on carbon intensity of individual companies. So basically, who is the worst, best in class? Okay, I will divest. We'll start divesting from this. And then the last is the value chain analysis of the companies that are involved in fossil fuels. Just to give you an example on this, on the value chain analysis, is the Norwegian pension funds, the Storebrand pension fund, divested from 13 coal companies, 6 companies having stake with the oil sands, and afterwards also from coal-heavy utilities. So all along the supply chain, so from upstream to the power stations. And whereas an example of tilting, of partial divestment, is by the Swedish pension fund, Second AP Fund, which in October 2014 decided to divest from 12 coal companies and 8 oil and gas companies. And these oil and gas companies had exposure on oil sands. So does divestment extend the carbon budget? So basically, in this HSBC graph here, we can assume that in economic terms, divestment works in extending the carbon budget, meaning that less demand for shares and bonds ultimately increase the cost of capital by lowering the prices of shares and bonds prices, and hiring the discount rate, and by consequence hiring the cost of capital to companies, and thus limiting, but this has a counter effect, because this limits the ability to finance expensive projects such as those in clean energy, so in renewable energy and energy efficiency. So damaging the energy sector. So because these projects, renewable energy and energy efficiency projects, let's say green projects, are long-term and have riskier internal rate of return because they are long-term investments. So from a carbon budget perspective, divestment seems positive, but there are many challenges ahead. So first of all, the increase of the cost of capital, but not only, the transition risks. Also, indirect, so the cost of transition, so indirect threats, including new regulations, shifting market demand, and also technology innovation and changing societal expectations. So, and last but not least, the financing gap, because we know that to finance energy transition, $1 trillion per year in clean energy is needed by 2030. So how to fill this transition gap, this energy transition gap, financing and transition gap. So let's say that the positive returns from divestment could be associated with retaining exposure to the energy sector. So divesting not cross-sector, but basically cross-industry. So, sorry, not cross-sector, but from fossil fuels to other kind of renewable energy sources, such as green renewable energy sources, but reallocating portfolios towards low-carbon energy, right? So, but clean energy investments, we know that have grown rapidly, and in 2014, $27 billion were invested in renewable energy, and in 2013, the world added more low-carbon electricity capacity than fossil fuel capacity. So everything seems positive in the framework, but still there is a financing gap. So how to fill this financing gap? How to attract private capital into the investment capacity to finance this transition? And one of the new finance vehicles that I would like to talk to you about is the green bonds. So green bonds are labeled bonds which are specifically issued to finance environmental protection, sustainability, or specific climate mitigation and adaptation measures. And they can be issued by governments, development banks, such as the World Bank, for instance, commercial banks, or even corporations. And as of 2015, a total of $598 billion of climate-aligned bonds were issued, of which 75 were labeled green bonds. So another specificity that I would like to raise is that the majority of issues are tenors over 10 years. So this reflects the long-term nature of climate assets, such as energy infrastructure bonds. And so this figure, this is from Climate Bond Initiative 2015. I will go quickly here because I have other two graphs that I would like to show. But anyway, in this graph, it's important to see that green bonds finance a range of green projects, and especially 45%, even more, almost 46% were issued to renewable energy projects, and almost 20% to energy efficiency. So this has the lion's share. So green energy has the lion's share in issuing green bonds. But there's also others. So agriculture, forestry, water, clean water, waste and pollution. There are even other investments. And also another thing that I would like to raise from this graph is the fact that in 2016, HSBC estimated that from 55 to $80 billion of issuance are foreseen into 2016. So, and this is the really, let's say, things that I would like to raise here is that all this will be from corporate. So all this issuance is foreseen to be from corporate, so from firms. Then from the geographical perspective, I'd like to show you this. This is a focus on the corporate bond, okay? So corporate bond issuance by region. We see that the Asian Pacific region has the lion's share in 2014 as for issuance of green bonds, and with 9.7 billion US dollar. And of this, China has the lion's share because China has 6.9 billion US dollar in 2014. And this is mainly, if we analyze which kind of firms, which other companies were involved in this, it's basically solar energy companies. So Jinko Solar and Trina Solar made the most of this. And as for America, so North and Latin America, as you can see, the share increased in 2014 with respect to 2013, but still is not as much as in Africa and as in Asia and Pacific. And the most interesting thing is that North and Latin American region issued less than China individually. So this is and almost all of the issues were made by Tesla Motor and Sun Edison's. So electric vehicles producer and Sun Edison, so renewable energy and solar energy producing companies. And if we go ahead, we go. This is this graph shows the corporate bond issues by sector. We see that in 2014 the lion's share is made by wind. So green bonds issued for wind projects, and followed by solar and electric vehicles and energy smart technologies. So it could be energy storage or any other smart technologies, smart meters, smart grids, and then followed by others. Others is geothermal, small hydro, and bioenergy. So to conclude, green bonds play a very important role, and they are also very good because they are used as refinancing tools for these renewable energy project investments, which are really long-term and entails, as I said before, and a very high risky internal rate of return. This is very important because green bonds can aim to ensure investors and developers that once operational risk is covered by them, then the assets can be refinanced through the green bonds. So also green bonds are looking increasingly attractive by insurance companies, especially in Europe. These insurance companies that aim to meet not only the risk and return objectives while producing also environmental and social positive impacts. And just to give you an example, Zurich Insurance Company Zurich Insurance Group, bought a green bond of $34 million US, and with a 30-year fixed rate from the World Bank in last year in February. So thank you very much, and if you have any questions, we are here. Any questions from Venice? No questions from Venice? Ah, sorry. Yeah, go ahead, sure.
Is there a question here?
No.
Okay.
So, I appreciate this is probably more of a synthesis report, but just like on the green bond issue, to what extent we see these growing? To what extent do we see this as just a reshuffling of financing of projects that now can be called green bonds, and to what extent is it actually providing additional finance? So when I was last year, Thomas Turner hosted a workshop in Paris and had both in the finance field talking about bonds, and they were saying that essentially, like the profiles were identical, the rate of return was identical, so there was no premium being offered to the green bond. It's sort of curious what's going on, and can we think that this is more than a labeling and that it has real potential to provide finance that wouldn't be there otherwise?
Yes. Thank you, Karen. I think that, well, green bonds is, yes, it's an issue, the fact of relabeling, and especially the fact of, yes, of being probably like double counting, But, I mean, this, I think, is something that needs to be analyzed and still adjusted, because it's not yet very clear. Even analyzing different documents is not very clear how much they are, the green bonds, compared to the other bonds, and it's really an issue. But as I said in the last slide, I mean, the green bonds are refinancing tools, so play a very important role. So in the transition, in the energy transition, I think that they really play an important role in project financing, in the last part of project financing as a financing tool, and the fact that they are attractive to insurance companies. This is very important because as we know, I mean, institutional investors, insurance companies, but also pension funds, are very reluctant to invest in green energy, and this, I think that it's something positive if, in this case, as we see that the case of Zurich Insurance Group, but many others, it's very positive if green bonds are used as attractiveness for private funding. So this is my. But I agree with the that they should do something about the labeling. I mean, something really about specifying exactly what these green bonds are and what are the projects, and if they are not projects that are already existing. Otherwise, this does not, it doesn't make sense.
If I can add, there is also, just on this point, there is an initiative. It's called Green Bond Initiative, whose aim is exactly the one that one of understanding which projects can be sourced by these green bonds. There's not also an ex-ante before the investment project problem, but also after the investments, understanding whether the projects are actually to degrees consistent. Because of course it can be a green project, but it's not maybe perhaps consistent with the energy transition in COP21 terms. So there is this initiative which is trying to make a project by project, let's say, assessment for helping the green bond market actually get more, let's say, critically sound. So that's it. I don't know if you could hear.
Okay. Any other question from Venice?
These the early spring goals, what should we expect that? It's only the incentive of taxation or something like that. You understand?
No, I didn't really. Can you repeat, please?
I mean, what you got an estimate of what is the early return, even that in home, it was like a bond, or relying on a company to do that.
Yeah. Well, as we've seen, I mean, facing the stranding risks, the carbon risk, physical carbon risk, and the operator's carbon risk. So green bonds is a possibility, another possibility for companies to reallocate their, their capital into some more, let's say, carbon careful or investments. So this is, I think, this is the main reason. But there possibly there are many others. But for sure, the fact that also they have a long tenors, normally over 10 years. This is something in the long term that can ensure energy infrastructure projects. So I guess there are maybe more reasons than that, but this is something that comes to my mind. Others?